I tell my interns and my students at class, if you were to travel around the United States and look at the biggest buildings around the United States that are in the skyline, guess what? They're insurance companies. They're insurance companies. And what do insurance companies do? They sell risk. They sell insurance. They don't buy insurance, they sell insurance. So the point being is this, even Warren Buffett figured out that buying the market is not as profitable as selling insurance on the market. In fact, a lot of people don't know that Warren Buffett owns Geico. What do insurance companies do very well? They manage risk very well. They sell insurance, which is extremely profitable, and then they figure out how to manage in case somebody has a claim. So here's what Warren Buffett looked at. Warren Buffett looked at, if I sell insurance to the market instead of buying insurance on the market. Now, Deb, what am I talking about? If you have a portfolio, if you have $1 million portfolio and you want to insure that portfolio, you could simply buy protective puts. You can insure your portfolio by buying tools that are designed to protect and insure your risk. Well, Warren Buffett said, wait a minute, why can't I be the one that's selling the insurance? And what he figured out is if I sell insurance to the market, I could beat the market. This is selling insurance to the market, and this is the market. Okay, so Warren's not a stupid man. He figured that. In fact, the CBOE, the Chicago Board of Options Exchange, did a study, and they said that if I sell insurance to the market, I could beat the market. And not only can I beat the market, I can do it with less risk. This is a standard deviation of actually owning the market. Well, this is revolutionary. So Warren Buffett is one of the biggest seller of insurance on the market. So what did we do at IPS? We said if Warren's doing it, we should take a look at it. Makes sense, right? It makes sense. So that's what we did. We started looking at selling insurance on the market. But here's the problem. I don't like this. I don't want my clients to experience this. Even though this is better, and this represents 2008 and 2009, I still am not happy with this. So what I told my team was, I said, team, here's what we're going to do. We're going to start with Warren Buffett's strategy, but we're going to make it much more conservative. We're going to build a strategy that's based on a much more conservative premise. So what we did was we took Warren Buffett's strategy and we actually put a triple net or a triple hedge on it. Now I'm using the word hedge to mean a net or protection. So we actually have 3 nets under Warren Buffett's strategy, if you will. We're going to call that selling insurance, Susan. We're going to call that Warren Buffett's strategy, and he's one of the #1 people to do that in the country. But we're going to make it more conservative by adding this triple hedge. Are you with me on this? Okay, good. So here's our first hedge. Now let's use an example. Fred, you live in Golden, right? Okay, and you like the beach? Okay. So Fred and Mary Ellen, they decide they're going to buy a place on the beach, and you find this beautiful doghouse. Beautiful doghouse. And it's expensive. It's a $500,000 home, but this doghouse happens to be on the beach, and it's the only place in the United States where you can see penguins surf. So this doghouse is $500,000. Okay, this is a very nice doghouse. This is a wonderful doghouse. So you call up your insurance agent because you're on the beach. You say, Mary Ellen, we need to protect our doghouse. So your insurance agent says, well, your doghouse is $500,000, and I'm going to charge you $10,000 a year to insure your doghouse. Well, Mary Ellen's like, there's no way I'm spending $10,000 a year to insure our doghouse. Well, the bottom line is I say, well, I'll tell you what. If you're willing to take a $100,000 deductible, I'll only charge you $5,000. That means, Fred, you cover the first $100,000 in loss, and then I'll eat the rest because I'm going to sell you the insurance. Okay, you with me on this? Are you picking this up? Okay. So you guys decide, okay, it's cool. Okay, everything's cool. And then you got a little fireplace in your doghouse because it's the winter time, and all of a sudden, guess what happens? Doghouse catches on fire. And your loss, it's going to cost you $90,000 to fix up your doghouse. Now, Fred, I got a question for you. I got a question for the audience. How much is Fred out? How much is Fred out? Very good. And he's actually out $95,000. Good. Daryl, nobody's picked that one up. How much am I out? I'm the insurance company. I'm actually up $5,000. Huh. Well, that's pretty cool. Okay, because of your deductible, because I'm not going to cover the first $100,000. That's why I gave you a discount in price. You got to cover the first $100,000. I'll cover the next $400,000. I just described to you what moneyness is, and this is our first hedge. And what that simply means is that we're selling insurance on the market, but we're not selling it at the price of the market. We're selling it off the market. So the market would have to fall approximately 4% a week for us to start losing money, or for you guys to start losing money in your portfolio. So that's our first hedge. So if the market dropped 3.9%, you would lose zero. The market would be down 3.9, you would be down nothing. If the market was down 4% a week every week for 4 weeks, the market would be down 16, Dale, you would be down nothing, okay? That's our first hedge, and that's exciting. Let's talk about our second hedge. Our second hedge is our skew. So let me explain what skew is. Okay, who am I going to pick on now? Okay, I'm going to pick Dale, and I'm going to pick on you. Okay, Dale, I know you're a farmer, and I know you love to farm. He's a big cattle rancher. You got that Kobe beef going. How's that working out for you? Good? Is it good stuff? Okay, I like that stuff. There's a great restaurant in Golden that sells that Kobe beef. Those sliders are Kobe beef sliders. The wine place that's really, really, what's the name of that wine place? Indulge. Have you guys been to Indulge? Great Kobe beef. Anyway, that's what you do for a living, but you're not having a good year. You're having a big drought, okay? And then you call up your insurance agent. You say, listen, I need to insure this farm. And he says it's going to cost you $2,000. And you're going, no way. I don't need to insure this thing. Nothing's going to happen. All of a sudden, you're watching the Weather Channel, because that's, Sarah, that's your favorite channel. That's what you watch all the time. And guess what? There's a tornado out there, a couple of 100 miles away. So you call Dale, you call up your insurance agent, you go, you know, I think I'll buy that insurance for $2,000, but guess what? He goes, because that hurricane, it's $4,000. So you hang up the phone, you're pissed. So then you wake up the next day, Sarah, you pick up and you're watching the Weather Channel, you go, uh-oh, that tornado's coming close to our house. You go, oh boy, I better call that insurance agent and buy that $4,000 insurance. But guess what? He tells you it's $6,000. What I just described to everybody in this room is skew. In other words, as the market comes down, as the market gets lower, the price that I get for selling insurance goes up exponentially. And that's very exciting. These first two hedges give us more protection and more money as markets go down. And that's very exciting. As markets decline, as we get lower, what happens is that the price of the option goes up, which means if I'm selling an option, I'm receiving more money. That's very, very exciting. And you can see that the skew does change as time goes on. The steeper the skew, the better for us if we're selling. And then our third hedge is something called our crash protection, our hurricane. If in fact your house got totally ripped apart in that tornado, this is what's going to pay off right here. Now we spend a maximum of about 4% a year. So if you're in our moderate portfolio, that's what it's costing you, about 4% a year. But that helps me sleep at night. That should help you, Lloyd, sleep at night. Let's go through this in a more visual way. So here is the price of the market today, and here's where Cal is going to sell insurance. And that's about 7 days, and that's about a 4% move. That's about an 86% probability that's not going to happen. Well, what happens is everybody in this room gets what? Hopefully you don't still get statements. Hopefully you have everything on email today. Hopefully nobody in this room. Sharon, are we on the same page? Okay, good. So you get this weekly thing, and what does it say? It says, okay, $20 sold. And then a week later, you get something in the mail, Fred, that says, bought back for $5 or $4 or $3, right? Happens every week, right? Every 7 days, right? Wednesday, Thursday, Friday of every week. So we sell and then we buy back cheaper. Because we're selling out of the money, we don't have to worry about a 3 or 4% move in any 1 week. That's our first hedge. But when the markets do drop, the markets go more than we sell, we do take a loss. That is a loss for that week. But here's the real beauty of the strategy. What happens is that the moneyness grows. And what does that mean to you? That means Cal is now selling for the next week, not at 4% out, but maybe at 5 or 6% out. And here's the real home run. Follow me, because this is brilliant. The real home run is, guess what happens? What happens is the skew grows. That means that we're actually getting more money for writing farther out of the money in week 2 if the market's dropping. So let's say you're getting $17 here, and then the market starts to go down. To go farther, more safer out of the money, I might be getting 25 or 30. If the market keeps going down, I might be getting 40 or 50. So we're getting safer and we're actually getting more money. It's a beautiful thing. It really is. It's the mechanics of the way that puts work. We love that. And of course, what happens is we write farther out of the money. That means I'm giving you less protection and you're paying me more money. That's what's happening. Our skew grows, and essentially our hurricane insurance is our third hedge, is our VIX. So let's talk about our third hedge. Our third hedge is a beautiful thing. We invest a little bit of money in this gray line. What happens is this insurance goes viral. So let's assume that we take $2,000 of your money and we put it in this thing called the VIX. And let's say we have another 9/11. That $2,000 can be worth $200,000. 300,000, 400,000. That explodes in value. It's a second derivative. And this thing works, this thing is magical when you have an exogenous event like a credit crisis, a 9/11. It doesn't work very well when I have a 3 or 4% slowed, but I don't need it because I have my first and second net, Susan. Does that make sense? I only need this when I got to buy the whole house back for the guy, when his house totally burns down. I don't need it for just minor repairs. Does this make sense to everybody? Sharon, are you with me on this? Are you picking up what I'm putting down? Okay, this is a good thing.